Imagine a global race. You've got two economic giants, right? Both vying for leadership in the future of digital money, but they're using completely different playbooks.
It's fascinating, isn't it? Stablecoins are supposed to be stable, but the paths regulators are taking, well, they're anything but stable themselves.
Exactly. This isn't just some dry regulatory debate. It's really a tale of two titans, each one shaping the future of digital money with entirely different philosophies.
Like a strategic chess match,
Yeah.
maybe. Japan making that first move, very cautious, deeply ingrained sense of caution.
While the U.S. has been playing a much more aggressive, almost market-driven game.
Yeah.
So today, we're diving deep into this scenario. We're calling it the stablecoin standoff. Japan versus the United States. We'll be unpacking these distinct regulatory philosophies, the market momentum in each country.
And our mission really is to pull out the most important insights from the sources we've looked at. We want to help you understand what's truly at stake here.
Why these different approaches matter, and crucially, what it might mean for the future of your crypto investments.
Yeah, we'll explore the surprising facts, the implications of these two diverging paths, looking at everything from the detailed regulatory frameworks.
All the way to real-world adoption rates. We're drawing insights from articles, research, expert analysis, everything we could get our hands on.
So let's try and decode these contrasting strategies and figure out what they mean for you.
Okay, let's unpack this first part. Japan. When it comes to stablecoin regulation, they actually took an early lead, didn't they? A really decisive lead.
They did. Japan became the very first country to enact a truly comprehensive framework for stablecoins.
It really feels like they were trying to set the global standard,
Yeah.
moving with, remarkable speed and clarity way before many other nations had even fully grasped what digital money really meant.
You're absolutely right. And the crucial insight here, the key moment, was 2023. Japan didn't just dip its toes in. It established its stablecoin regulatory framework under its Payment Services Act.
The Payment Services Act, okay.
And that move truly set a global precedent. It was genuinely significant because it formally defined stablecoins,
Yeah,
gave them a specific category as digital money.
which is a critical legal distinction, right? Brings them under existing financial oversight.
Exactly. And at the same time, it laid out very specific, you could say prescriptive, rules for how they could be issued.
And when you say specific rules, you mean strict rules, don't you? I remember reading about that. What's the core of that strictness? Why is it such a defining feature of Japan's approach?
Indeed, strict is definitely the word. The core detail here, and it's something that really sets Japan apart, is who can issue them. Only licensed banks, trust banks, or registered money transfer agents are permitted.
Ah, so a very limited pool of issuers.
Very limited. It's a highly controlled, almost exclusive approach right from the get-go. And this reflects a deep-seated regulatory philosophy, one that prioritizes bedrock security, systemic stability.
So it's not just about limiting who issues them, it's a risk strategy.
It's fundamentally a risk mitigation strategy, yes. But confining issuance to these heavily regulated institutions, like banks, Japan is essentially plugging stablecoins directly into their existing robust financial safety nets.
Makes sense.
So these stablecoins immediately become subject to really stringent capital requirements, rigorous liquidity rules, and well-established anti-money laundering AML and Know Your Customer KYC regulations.
Stuff that's already battle-tested in their traditional system.
Precisely. So it immediately addresses many of those concerns about counterparty risk, potential insolvency, illicit finance, things that have unfortunately plagued some of the less regulated corners of the crypto market globally.
You used the analogy earlier, like building an earthquake-proof foundation. That's powerful. But couldn't that kind of meticulous, front-loaded regulation actually stifle the very innovation it's trying to protect?
That's the flip side, isn't it?
Yeah, maybe pushing promising projects to places with, looser rules. What does this tell us about Japan's core intentions, especially given their history?
That's a really perceptive question, and it speaks directly to the inherent trade-offs in any regulatory approach. This controlled strategy definitely reflects a core Japanese regulatory philosophy that heavily prioritizes systemic stability and robust consumer protection, almost above everything else.
You mentioned their history.
Right. If we connect this to the bigger picture, it's particularly understandable given their past experiences with digital asset volatility. You just have to think back to major events like the Mt. Gox hack.
Oh yeah, huge, especially in Japan.
Exactly. It was deeply traumatic for the crypto community globally, but especially in Japan where it all unfolded. That event left well, an indelible mark on their regulatory psyche.
So they wanted to prevent anything like that from happening again.
Absolutely. They wanted to build that secure foundation first. Ensure that any stablecoin integration wouldn't introduce new systemic risks into their financial system. So, back to the analogy. Constructing that robust, earthquake-proof foundation for a skyscraper before you even start putting up the walls.
It takes more time, more planning up front. Feels slow, maybe?
It does. But the intention is clear. Long-term resilience. Safeguarding against future shocks. They're trying to prevent issues before they arise rather than just reacting after a problem occurs. It's a measured, cautious approach, deeply embedded in their financial regulatory DNA, prioritizing trust and security above all.
Building for durability, okay. And yet, this deep-seated caution, as you describe it, seems to have created this interesting tension. You have the early clarity, but then slow market uptake. That's the paradox we mentioned earlier, right?
It is.
Japan had this clear rulebook early on, first mover on comprehensive regulation. You'd think that clarity, that strong foundation, would lead to rapid adoption, like a signal, here are the rules, now go build.
You would think, though.
But the sources suggest a very different story, almost paradoxical, like building a perfect highway, but the cars haven't quite shown up yet.
You've hit the nail on the head. That's the core of the paradox, and it's genuinely one of the most intriguing aspects of Japan's journey. Despite having this comprehensive early regulatory framework in place since 2023.
We just haven't seen that vibrant yen stablecoin market you might anticipate.
Exactly. Real-world usage has been surprisingly limited. It created this situation where regulatory certainty didn't immediately translate into market dynamism. So while some issuers technically exist or they're in various stages of development, the actual integration into daily transactions or into broader crypto ecosystems, it just hasn't taken off in a major, widespread way yet.
It hasn't mirrored that kind of explosive, sometimes speculative growth we've seen elsewhere, like with dollar stablecoins.
Not at all. It's almost as if the market is still hesitant or maybe just moving very deliberately, even with that clear guidance.
So the rules are meticulously written, the playing field is defined, but the teams aren't quite on the pitch yet, or at least not playing at full speed.
That's a good way to put it.
It really suggests that regulation alone isn't some kind of silver bullet for market adoption.
Precisely. However, and this is an important nuance, it's not entirely static, there are new players emerging on the horizon. That indicates some crucial movement in the market, even if it's been slower than some might have expected.
Okay, so there are signs of life.
Definitely.
Yeah.
For instance, there's JPYC. It's described as a fully collateralized, yen-pegged stablecoin. And importantly, it's backed by highly liquid assets, things like bank deposits and government bonds.
Which aligns perfectly with Japan's strict rules.
Exactly.
Yeah.
High stability, high liquidity. And it's slated for launch this fall. That's a significant development. Furthermore, Monex Group.
A big name in Japanese finance, right? Brokerage sector.
That's the one. A major player. They're also publicly considering launching their own stablecoin. These are strong signals that the market is starting to stir, albeit at a more deliberate foundational pace.
And these aren't just speculative startups, they're established players.
Right. Deeply ingrained in the Japanese financial system. That matters.
That is interesting. It shows there's still underlying interest and development, even if the initial rollout has been measured. But why? What do you think really contributes to this slow adoption, despite that regulatory clarity that was supposed to be a catalyst? Is it just that cautious nature you mentioned, or is there more to it?
Well, I think this slow adoption, despite the clear legal runway, probably stems from several deeply rooted factors. Firstly, the inherent cautious nature of Japanese financial institutions is undeniable.
It's cultural, almost.
It seems to be. They operate with this deeply ingrained cultural predisposition for thoroughness, risk aversion. They tend to move very deliberately. Extensive due diligence, protracted risk assessments before diving into new tech, especially something like stablecoins.
A marathon, not a sprint for them.
Exactly. Secondly, there might just be some initial friction with the detailed regulatory requirements themselves. While they are clear, these strict rules can also present a substantially higher barrier to entry for potential issuers.
The clarity comes with complexity.
Precisely. Imagine you're a small Japanese tech startup, right? You want to launch a yen stablecoin. On one hand, great. You have regulatory clarity, you know the rules. But on the other hand,
You've got to navigate a maze of compliance.
a maze. Maybe partner with a conservative megabank. Incur significant legal and operational costs up front. Adhere to strict capital and reserve requirements from day one. It's a heavy lift.
Which might explain why smaller, maybe more innovative players aren't just rushing in.
It could certainly contribute. And this raises a really important question for you, the listener. Is regulatory clarity alone enough to spur widespread adoption? Or does market-driven innovation also need ample space to flourish? Maybe even in an environment with less initial prescriptive regulation. The Japanese experience so far suggests that while clarity is good, essential even, it doesn't automatically guarantee rapid uptake if the market isn't fully ready, or maybe just not sufficiently incentivized to overcome those initial hurdles.
It sounds like Japan isn't just sitting idle, though. They're not just waiting for the market to magically catch up to its regulations. They seem to have a long-term vision, focusing on fundamental building blocks.
Exactly.
It feels like it's not about immediate retail adoption, but something much deeper, a different kind of strategy altogether.
Absolutely. While they're slower to see that immediate, broad retail adoption, Japan is clearly focusing on building foundational infrastructure and fostering strategic collaborations. That indicates a long-term, deeply considered vision.
It's not passive then.
Not at all. It's a deliberate, slow-burn, scale-up strategy. For example, sources show companies like Startail and SBI. They're actively developing platforms for tokenized stocks.
So traditional shares, but on a blockchain.
Essentially, yes. Allowing things like fractional ownership, faster settlement, maybe cheaper settlement, potentially outside traditional market hours. They're also working on tokenized real-world assets, think real estate, commodity.
Wow, okay.
And even programmable treasuries, government bonds that can automatically execute conditions through smart contracts. This all points to a very clear push toward enterprise-grade adoption, deep integration within the existing financial system.
Rather than just a quick, broad consumer rollout for everyday payments.
Precisely. They seem to be targeting specific, high-value institutional use cases first, places where stability, security, and regulatory compliance are absolutely paramount, and where the benefits of blockchain's efficiency can be most impactful.
That's a fascinating distinction. So instead of trying to get everyone to use yen stablecoins for their daily coffee, they're aiming for larger, more complex financial transactions and assets. It sounds like a different kind of growth strategy, building from the top down maybe, rather than the bottom up.
It is indeed. And this strategy has striking parallels with something else we saw in Japan, the adoption curve of QR code payments.
Oh, interesting. How so?
Well, initially, QR code payments were actually pretty slow to gain traction there. Despite being widely available, highly functional, consumers were just used to cash. Merchants had to adapt.
Right, inertia.
Big time. However, once that underlying infrastructure became robust, once consumers and merchants slowly but surely started integrating them into their daily habits, adoption grew rapidly, almost explosively.
Ah, so the hope is stablecoins might follow a similar path.
That seems to be the strategic intent, yes. A gradual buildup of the foundational layers, the institutional trust, followed by accelerated, widespread adoption once the ecosystem is mature and fully integrated into the fabric of their financial lives.
So connecting this to the bigger picture, Japan's approach suggests focusing on deeply embedding stablecoins within the existing system for specific, high-value, enterprise-level use cases first.
It's a very different trajectory from just aiming for broad consumer payment solutions from day one, which, let's face it, tend to be more volatile and less regulated initially in many markets.
Okay, so for you, the listener, what could this mean?
Well, it could mean that yen-backed stablecoins, when they do finally gain widespread traction, might be exceptionally stable, deeply integrated into traditional finance, and potentially offer a different kind of investment opportunity.
Different how?
Perhaps one focused more on institutional-grade security, long-term value preservation, maybe a lower risk profile, rather than purely speculative trading in a fast-moving retail market.
Right.
It's really about stability and deep integration first.
Okay, let's pivot now. Across the Pacific, let's look at the United States. The U.S. seems to be playing a different game entirely, doesn't it?
Completely different.
Characterized by rapid institutional interest, lots of innovation, almost a sprint compared to Japan's measured, deliberate pace. The philosophies here feel worlds apart.
That's precisely it. The U.S. approach is clearly marked by significant, often organic market momentum. And this momentum has been building dramatically even before comprehensive federal legislation was really in place.
Right, the market kind of ran ahead.
It really did. We've witnessed a tremendous amount of market-driven growth and innovation. However, looking ahead, the Genius Act, slated for 2025, that marks the country's first substantial piece of federal stablecoin legislation.
Genius Act. Okay, that's a key development.
It's critical. because it signals an upcoming, more formalized, more unified federal structure for a market that, until now, has largely grown under this patchwork of state-level rules and agency-specific guidance.
And crucially, how does it compare to Japan's strict approach on who can issue?
That's a major difference. The Genius Act is designed to be far more inclusive. It explicitly allows both licensed banks and federally licensed non-bank financial institutions to issue stablecoins.
Both. Okay, that is a much broader invitation.
It really is. It recognizes the diverse players who've already built the current stablecoin ecosystem.
That's a huge difference right there, explicitly allowing non-banks into the game at the federal level. What does that openness signal about the U.S. regulatory philosophy? Does it prioritize innovation over that rock-solid stability Japan seems to be aiming for?
I think this broader invitation for participation is fundamentally designed to foster innovation. The idea is by allowing a wider array of entities to enter the market, you get more competition, more experimentation.
Keep the U.S. competitive in fintech.
Exactly.
Mm-hmm.
It reflects a regulatory philosophy that's perhaps more comfortable with a degree of market-driven experimentation and evolution, even while trying to establish robust guardrails. The thinking seems to be, open up the field, encourage diverse solutions, accelerate tech advancement, ensure the U.S. stays a leader.
And it acknowledges reality, too, right? A lot of the innovation has come from non-banks.
Absolutely. It realistically acknowledges that much of the existing stablecoin innovation has come from these agile, non-bank entities who are often at the forefront of digital asset development. Now, it's crucial to say it's not a complete free-for-all.
Right, there are rules attached.
Definitely. The Act also sets clear reserve requirements, audit standards, compliance standards, which is vital for consumer confidence and systemic integrity.
What kind of standards are we talking about?
Well, we're expecting provisions mandating, for example, one-to-one backing with highly liquid assets, maybe even specific requirements for where those reserves can be held, like segregated accounts at regulated banks, or perhaps a blend of cash and short-term U.S. Treasury bills.
And the audits. That's been a big point of discussion.
Critical. The audit standards are likely to require regular, independent attestations to ensure transparency and trust, moving beyond the self-attestations we've sometimes seen in the past.
So it signals a clear intent to legitimize the market, integrate stablecoins more formally.
Yes, while still proactively mitigating risks through established financial controls. So not a free-for-all, but certainly a more expansive, less restrictive approach to who gets to play compared to Japan.
Okay, here's where it gets truly fascinating for me, and maybe a little counterintuitive when we compare it directly to Japan. The U.S. saw this absolute explosion of dollar-backed stablecoins. You mentioned USDT, USDC, and this happened before much of this federal oversight was even really on the table.
It's quite something.
How did that scenario, some people called it the Wild West back then, how did that manage to foster such immense growth?
You've highlighted a truly remarkable aspect of the U.S. stablecoin story, how the market developed organically first, almost in a vacuum of clear federal regulation.
It just happened.
The sheer volume and the widespread use of stablecoins like USDT and USDC created this de facto demand, this utility that regulators frankly just couldn't ignore. These assets became crucial liquidity bridges within the broader crypto ecosystem.
For trading,
Facilitating trading, DeFi lending, cross-border payments, just essential plumbing. So the Genius Act, in a really profound sense, is legitimizing what the markets had already embraced and built from the ground up.
That's such a stark contrast to Japan, where regulation came first, then maybe adoption.
Exactly. In the U.S., the market moved first. It created established use cases, robust liquidity, a vast global user base, and now the regulation is catching up, providing formal recognition and oversight to these existing incredibly dynamic ecosystems.
And that pre-existing adoption, that must have fueled even more interest.
Absolutely. It catalyzed rapid institutional interest and further innovation in dollar-backed stablecoins, made the U.S. market incredibly dynamic. Businesses, developers, they already had established platforms, liquidity pools, a global user base. That provided a really strong foundation for continued growth and diversification.
So it's almost like the market built the house, maybe a bit messy in places, and now the regulators are coming in to add the proper plumbing system, the electrical wiring, make sure it's up to code.
That's a pretty good analogy, actually.
This market first, regulate later approach, it sounds like it has significant advantages, obviously, in terms of speed and innovation, but also potential downsides, right? Given that initial lack of clear rules.
Indeed. That market first, regulate later approach definitely allowed for faster iteration. The development of incredibly diverse use cases you mentioned, DeFi lending.
Yeah, decentralized finance. Lending, borrowing crypto without banks, using smart contracts.
Right, and cross-border payments too. Because innovation wasn't initially constrained by overly prescriptive rules. And this accelerated growth, you can see it vividly in the data, the high total value locked, or TVL, in DeFi protocols.
That measures the crypto assets deposited in these decentralized apps, right?
Correct. And just the staggering daily transaction volumes for dollar-backed stablecoins, it's immense. However, the flip side, as you said, it also meant a period of operating in a less clear regulatory environment.
Which introduces risks.
Undoubtedly.
Huh.
Its own set of risks and uncertainties for participants. There were periods of ambiguity, questions around consumer protection, reserve transparency, AML compliance, things the Genius Act now aims to standardize.
Okay, so for you, the listener, the investor, what's the takeaway from this U.S. model?
For you as an investor, this means the U.S. market, specifically for these dollar-backed stablecoins, has a proven track record, proven adoption, exceptionally high liquidity, and a really wide array of existing use cases and integrations within the broader crypto economy.
Some more immediate opportunities, perhaps.
Potentially, yes. More immediate opportunities for yield, for utility, for engagement within a dynamic and expansive digital asset landscape. It could be an attractive space if you're looking for more immediate and diverse ways to engage with crypto finance.
So, zooming out again, what does this all mean for the underlying philosophy, the core approach the U.S. is taking? It feels like they're making a calculated strategic move, not just domestically, but on the global stage.
You've precisely captured it. The U.S. distinctly signals a bigger market opening play. This isn't just about fostering domestic innovation. It's profoundly about global competitiveness.
And leveraging the dollar's power.
Absolutely. Leveraging the existing immense global dominance of the U.S. dollar, but extending it into the digital age. The philosophy here suggests a willingness to balance innovation with regulation, maybe even allowing for a higher degree of calculated risk to stimulate growth and ensure the U.S. remains at the forefront of digital finance.
Retain and extend the dollar's reserve currency status into the digital world.
That seems to be a core goal. And this is also powerfully evident in the anticipated flexibility of the Genius Act's framework. Unlike, say, Japan's very specific 1 million transaction cap.
Which is what, roughly $6,500 USD?
No.
Something like that?
Around that, yes. Which really implies a focus on smaller, maybe retail or mid-sized transactions. The U.S. framework is likely to offer far more flexibility.
That 1 million cap is quite specific. It absolutely limits the scope. So the U.S. is looking at a much broader scope of use cases then. Retail, institutional, high-value transfers, everything.
Absolutely. That flexibility in the U.S. framework will potentially enable stablecoins to be used for much larger transactions, a wider variety of applications.
Yeah.
Far beyond what might be practical or even intended under a strict cap like Japan's.
We already see that happening, right? The transaction data shows it.
Clearly. You can see in the existing transaction data for dollar-backed stablecoins, high-volume, high-value transfers that already routinely exceed such a limit. These are transactions underpinning everything from institutional trading to large-scale international settlements.
So the U.S. model aims to bring yield, liquidity, utility sooner, and to a broader range of activities and participants.
That's the goal, from retail users to large corporations, financial institutions. This proactive, market-embracing approach could translate into faster growth, a more diverse array of products and services for you, the listener. Whether you're an individual investor, a business looking for efficient payment solutions, or a developer building new financial apps.
It's fundamentally about maintaining global financial leadership by embracing and actively shaping this new, powerful technology.
That sums it up well.
Okay, we've now laid out these two very distinct paths. Japan's early but cautious regulatory lead, the U.S.'s market-driven momentum with regulation catching up. Let's really dig into these regulatory philosophies at odds. What are the fundamental differences here? Because they represent two truly different visions for the future of digital finance.
This really raises that important question, doesn't it? Which approach is ultimately better? Better for the long-term health, the resilience, the stable growth of the stablecoin ecosystem?
And it's not a simple answer, I suspect.
Not at all. Because both have compelling arguments. Japan, as we've discussed at length, clearly prizes systemic stability above innovation speed. Their framework reflects that conservative stance, meticulously prioritizing preventing systemic shocks, ensuring robust consumer protection through strict controls, limiting issuance to those highly regulated financial institutions.
Building for absolute trust and durability from day one.
Exactly. On the other hand, the U.S. signals that bigger market opening play, aiming to capture first-mover advantages, foster rapid innovation, stimulate economic growth, even if it means navigating a more dynamic and perhaps initially riskier landscape.
So it's about facilitating growth, leveraging existing market forces, then refining the rules as the market matures.
That seems to be the pattern.
So it's not just a difference in specific legal rules then, it's a profound philosophical divergence. How they view risk, economic development, even the role of government in fostering new tech.
Precisely. This isn't just a difference in regulations on paper. It's a profound divergence in core economic and risk management philosophies. Japan's approach is about laying down that unshakable, earthquake-proof foundation, even if it significantly delays building the full skyscraper.
They're willing to sacrifice that immediate explosive growth.
For long-term security, resilience, and maintaining that deeply ingrained trust their population has in the financial system, they want to avoid any possibility of another Mt. Gox, period.
While the U.S. seems more comfortable with some initial calculated risk.
It appears so. Embracing market-driven innovation with the goal of achieving greater potential returns and cementing market dominance for the dollar in the digital realm, they're essentially allowing the market to experiment, find its footing, then stepping in to formalize and regulate once viable models emerge.
And that adoption timeline comparison really highlights it.
Starkly. Japan's early regulatory rollout in 2023 versus U.S. market-led adoption that was already massive before federal legislation. We see how regulatory clarity in Japan didn't immediately start market vibrancy.
Whereas in the U.S., market vibrancy came first and is now shaping the legislation.
Right. It highlights those fundamental trade-offs inherent in each approach. One leans towards caution, long-term security, the other towards speed, innovation, and aggressively seizing market opportunities.
Okay, this isn't just some academic debate about regulatory theory, though. This has real, tangible implications for you, our listener, and your crypto investments. How do these two distinct philosophies directly impact what you should be thinking about as you navigate the digital asset space?
Well, knowledge is most valuable when you can understand it and apply it, right? For crypto investors, regulatory clarity is absolutely foundational, no doubt about it. It provides certainty, reduces policy risk, creates a more stable operating environment.
But
adoption, utility, and innovation are what truly drive real impact, real utility, and ultimately potential returns. So the U.S.'s inclusive model, allowing banks and non-banks leveraging that existing massive adoption of dollar assets, it may bring yield, liquidity, and utility sooner.
because of that broader participation, that market-driven approach.
Exactly. It means potentially more immediate opportunities for engaging with DeFi protocols, participating in cross-border payments, integrating with that vast array of existing blockchain platforms and applications that already heavily use dollar-backed stablecoins like USDC and USDT.
So you might find a wider, more diverse range of products and services built around those assets, offering more flexibility, more immediate utility for your digital finance activities.
That's the potential upside of the U.S. approach, yes.
Yeah.
More immediate action, more options readily available now.
And what about Japan's approach then? What kind of investor might that appeal to, especially given its laser focus on institutional-grade security and deep integration?
Right. Conversely, Japan's measured approach, with its strict focus on systemic stability, only allowing those highly regulated entities to issue, that may pay off differently. It could result in unparalleled stability and infrastructure leadership in the long term, especially within the crucial Asian market.
So appealing to a different type of investor.
Potentially, yes. Someone seeking extreme security, institutional-grade integration, perhaps a slower, more deliberate, but ultimately maybe more guaranteed path to widespread adoption within traditional finance.
So if you prioritize safety, robust oversight, deep integration with established systems, maybe long-term value over short-term gains,
Then Japanese yen-backed stablecoins, when they scale, could offer a very compelling, albeit different, value proposition. It's less about speculative yield hunting and more about secure, predictable value transfer within a highly regulated ecosystem.
So it really depends on your investment strategy, whether you prioritize immediate growth and diverse opportunities in a dynamic market, or long-term stability and robust, secure integration into traditional finance.
These two models offer very different potential outcomes. They cater to different risk appetites, different investment horizons. You need to understand which aligns better with your own goals.
It certainly seems like they're on completely different tracks, almost like two trains heading in parallel, but maybe not necessarily towards the exact same station. It makes you wonder, can these two seemingly opposing philosophies ever converge or collaborate? Is there a possibility of a hybrid model, or are they just destined to run their own separate races?
That's an insightful way to frame it, and I think the answer is a resounding yes. There's absolutely potential for convergence and collaboration.
Yeah.
We have to remember, if we connect this to the bigger picture, the global stablecoin economy is still in its relatively early stages of evolution.
Still figuring things out.
Very much so. And we already see tangible examples of this kind of cross-pollination happening. You mentioned earlier the Ripple plus SBI collaboration in Japan.
Right, a U.S. company working with a major Japanese institution.
Exactly. That showcases the immense potential for U.S.-Japan hybrid stablecoin adoption models. This isn't just theoretical. These partnerships are actively being explored, being developed. It demonstrates that leading players clearly recognize the value in blending these distinct strengths.
So taking Japan's regulatory foundation and infrastructure focus.
And combining it with the U.S.'s innovation drive, its extensive market reach, that existing deep liquidity in dollar-backed assets.
That could be incredibly powerful, a real synergy, truly the best of both worlds, in a way.
It could be. So it's not necessarily about one winning over the other. It might be more about mutual learning, a blending of strengths that could ultimately benefit the entire global digital economy.
So these partnerships could lead to stablecoins that are both highly secure, thanks to Japan's oversight, and widely adopted, thanks to U.S. market dynamism, potentially setting a new global standard.
That's the hope, or at least a possible positive outcome. It highlights that it's not necessarily an either scenario. It could very well evolve into a both-hand approach in the long run.
Maybe the different approaches will inform each other over time.
I think that's highly likely, as both regimes observe the successes and the challenges of the other. For instance, maybe Japan looks at the U.S.'s rapid innovation and considers ways to carefully foster more market activity within its secure framework.
And maybe the U.S. looks at Japan's stability and considers how to further strengthen consumer trust and long-term resilience.
Exactly. There could be a gradual convergence, or at least a harmonization of best practices, leading to a more mature, more resilient, and more globally integrated stablecoin market overall, one that really balances security with innovation effectively.
The journey is definitely far from over.
Absolutely. And how these two giants influence each other, learn from each other, that will be absolutely critical for the future of digital money. #outro.
Well, we've taken quite a deep dive there into the fascinating stablecoin standoff between Japan and the U.S. We've explored two really distinct visions for the future of digital finance.
We have. We've seen Japan's early regulatory lead, paired with that slower adoption, focusing intensely on systemic stability.
Versus the U.S.'s market-driven momentum, that inclusive approach prioritizing innovation and speed, with regulation now formalizing things.
And each path presents unique opportunities, unique challenges for the global crypto landscape, and most importantly, for you as an investor.
As these two powerful economies chart their courses, it definitely leaves you with plenty to consider. Think about which model you actually prefer for stablecoin development. Is it Japan's safety-first, institutionally integrated approach?
Or is it the U.S.'s innovation-first, market-driven approach? Both have compelling arguments and, as we discussed, very different implications for your own investment strategy.
Also consider this. Would you be more inclined to use a yen-backed stablecoin if Japan maybe simplifies its transaction limits, perhaps lowers fees? Could it potentially mirror that rapid growth curve we eventually saw with QR payments there?
That kind of shift in adoption could drastically change its utility. And looking ahead, which regime do you think will ultimately dominate? Will Japan lead the Asian stablecoin economy? Will the U.S. dominate the broader global stablecoin market? Or will we see more of that hybrid approach?
The answers to these questions, well, they'll undoubtedly shape how you interact with digital currency and the opportunities you pursue in the years to come.
Absolutely. And hey, if this deep dive helps spotlight why the U.S. seems to be racing ahead despite Japan's regulatory lead, or if it just gave you some sharp, digestible Web3 insights,
we'd love for you to like this video, subscribe to our channel, and maybe hit that notification bell.
Yeah, your support really does help us continue to grow. It boosts our visibility in the algorithm, which is, how things work these days.
It really does. And it allows us to keep delivering this kind of quality crypto content just for you. Every like, every comment, every share makes a huge difference, helping us reach more curious minds like yours.
We truly appreciate you engaging with us.
We absolutely do. And we can't wait to continue exploring the fascinating world of digital finance with you.